Hey everyone, welcome back to Corporate Decoder, the place where we dive into the exciting world of corporate filings. Today we're looking at a report from Hertz. Get ready because it involves a whole lot of cars, debt and numbers that might make your head spin faster than a sports car on a racetrack. Hertz, the rental car giant, just made a big move involving something called asset-backed notes. Think of it as Hertz borrowing a ton of money using their rental cars as collateral or security. Basically, if they don't pay back the loans, the lenders could potentially take the cars. To get into the details, Hertz Vehicle Financing 3 LLC, or HVF3, which is like a special part of Hertz, just for this kind of thing, issued two sets of notes. Notes are just another word for loans or bonds. They sold these notes to other companies. To get money, one set is called Series 2025-2. Each of these series is worth $500 million. These notes aren't just simple loans, they're tied to a base indenture. Imagine the base indenture as the main agreement, and these series are add-ons or supplements to that agreement. The main players are HVF3, which is Hertz's special borrowing part, the Hertz Corporation, or THC, which is handling the money and managing things, and the Bank of New York Mellon Trust Company, or BNY, which is acting as a trustee or guardian to make sure everything goes smoothly. These Series 2025 notes, the ones that total $1 billion, are how Hertz pays for its rental car fleet in the United States. They might issue more notes in the future if things go well. Now, for the juicy numbers, let's break down these loans. The Series 2025-1 notes are divided into four classes, A, B, C, and D. Class A got 342 time fin, 5C got $67 2020, but the legal final payment date, the absolute last day to pay, is September of 2029. The Series 2025-2 notes also have four classes with the same amounts, 342 tom and $5 million for Class A, $50 million for Class B. However, the interest rates are slightly higher, 5.3% for Class A, 5.13% for Class A, 5.66% for Class B, 6.40 with a legal final payment date in September of 2030, with a legal final payment date in September of 2030, with a legal final payment date in September of 2030, with a legal final payment date in September of 2030, with a legal final payment date, September of 2030, with a legal final payment date in September of 2030, with a legal final payment date in September of 2030, with a legal final payment date in September of 2030, with a legal final payment date in September of 2030, with a legal final payment date in September of 2030, with a legal final payment date in September of 2030, with a legal final payment date in September of 2030, with a legal final payment date. Here's where it gets a bit complicated. Some of these notes are subordinated. This means that if Hertz runs into trouble and can't pay everyone back, some lenders get paid before others. For example, Class B note holders get paid after Class A note holders. Class C gets paid after Class A and note holders. Class C gets paid after Class A and B, and so on. Class D is last in line. This makes the lower classes riskier, and that's why they have higher interest rates. It's like saying, I know there's a higher chance I won't get paid back, so I'm going to charge you more to lend you the money. Hertz doesn't have to start paying back the main amount or principal on these loans until April of 2028 for the first series and April of 2030 for the second series. After that, they're expected to pay 1/6 of the initial amount every so often until it's all paid back by the final payment date. But there's a catch. There are things called amortization events that could force Hertz to pay back the loan sooner. These events include things like not paying interest or principal on time, not having enough assets to cover the debt, having problems with other agreements, or breaking promises. If these events happen, the lenders can force Hertz to sell cars to get the money to pay them back. There's also a master motor vehicle operating lease and servicing agreement. Think of it as a rental agreement for the cars between HVF3, the lending part of Hertz, and other parts of Hertz that actually use the cars for rentals. If Hertz messes up the payments on the loans, they might have to return the cars. If Hertz has to sell cars because of these problems, the money from those sales has to go towards paying back these Series 2025 notes and any other debts that HVF3 might have. The money that Hertz borrowed from these new notes was used to pay back some older loans called the Series 2021A Variable Funding Rental Car Asset-Backed Notes. The rest of the money will be used to buy more cars or refinance existing ones. Refinancing is when you take out a new loan to pay off an old one, often to get better terms. If you want to read all the fine print, you can check out the full agreements, which are filed as exhibits. This part just mentions that the previous information about the loans is also relevant to this section about financial obligations. It's just a cross-reference. And finally, this section lists the exhibits, which are the actual legal documents that detail everything we just talked about. So what does all this mean? Hertz is taking on a lot of debt to finance its rental car fleet. The interest rates on these loans are pretty high, which means it's costing them a lot to borrow this money. They need to manage their assets and operations carefully to avoid any amortization events that could force them to sell off cars. The risks are significant, but if they manage it well, this allows them to operate and acquire vehicles to rent out. It looks like Hertz is betting on a strong future for the rental car business. They're taking on a lot of debt, hoping they can generate enough revenue to pay it all back. Thanks for watching. If you found this corporate deep dive interesting, hit that like button, leave a comment, and don't forget to subscribe for more Decoder action.